What is going on, beautiful people? Welcome back to Boni's Life. I am your host, Boni, and today we are diving deep into the crypto market with one of the most important episodes I have ever put together. Whether you are a short-term scalper, a mid-term swing trader, or a long-term investor building generational wealth, this episode is specifically designed for you. We are going to break down exactly what type of market we are trading right now, analyze every critical indicator from volume to open interest to the fear and greed index, identify the technical setups and triggers for your next trades, cover the global events that are shaking the markets as we speak, and then give you actionable strategies tailored to your trading time frame. So grab your coffee, grab your notebook, and let us get into it. Let me start by painting the big picture for you, because if you do not understand where we are in the market cycle, nothing else matters. As of today, March 9th, 2026, Bitcoin is trading at approximately $68,680, which represents a 2.5% gain in the last 24 hours. Now, that might sound positive on the surface, but here is the context that changes everything. Bitcoin hit its all-time high of $126,080 back in October 2025, which means we are currently sitting 45.5% below that peak. Let that number sink in for a moment. We are nearly half of the highs. The total cryptocurrency market capitalization stands at $2.425 trillion, according to CoinGecko, with a 24-hour trading volume of approximately $100.9 billion. Bitcoin dominance has climbed to 58.51% on CoinGlass, while Ethereum dominance sits at just 10%. When Bitcoin dominance is this high and rising, it tells you one very important thing. Capital is flowing out of altcoins and consolidating into Bitcoin. This is not a market where you want to be a hero chasing small cap altcoins. This is a market that demands discipline and precision. Now let me tell you exactly what type of market we are in, because I know that is what you came here for. We are in a corrective consolidation phase within a broader secular bull cycle. Some people will call this a bear market, and I understand why, because a 45% drawdown from the highs certainly feels like one. But the structural indicators tell a different story. Bitcoin is still trading well above its 200-week moving average. Institutional accumulation through spot ETFs has added over 700,830 Bitcoin since January 2024. And the macro backdrop, while turbulent, has not fundamentally broken the long-term thesis. What we are experiencing is a deep correction driven by a perfect storm of geopolitical uncertainty, stagflation fears, and aggressive profit-taking after a parabolic run to $126,000. Think of it like this. The bull market took the elevator up, and now it is taking the stairs down. The question is not whether the bull market is over. The question is where the stairs end and the next elevator begins. Let us now dive into the indicators that are telling us the real story beneath the surface. Starting with volume, the 24-hour trading volume across all crypto assets is $100.9 billion on CoinGecko, while CoinGlass shows futures volume at $175.87 billion, which is up a massive 54.51% in the last 24 hours. That volume spike is significant because it tells us that traders are actively positioning themselves. Volume does not lie. When you see volume increasing during a period of extreme fear, it often signals that smart money is accumulating while retail is panic selling. Bitcoin alone accounted for $67.99 billion in futures volume, up 59.45%, while Ethereum saw $50.31 billion, up a staggering 73.34%. These are not the volume numbers of a dead market. These are the volume numbers of a market that is about to make a decisive move. Now let us talk about the indicator that has everyone talking, and for good reason. The fear and greed index is sitting at 7. Let me repeat that, 7. That is deep in extreme fear territory. And according to CoinGlass data, it dropped 6 points from yesterday's reading of 13. The 7-day average is just 13, which represents the lowest sustained readings since the 2022 bear market bottom. Now, I know what some of you are thinking. Boni, extreme fear means the market is going to crash further, and I completely understand that instinct. But history tells us something very different. The fear and greed index is a contrarian indicator. When it reads extreme fear, it historically marks some of the best buying opportunities in crypto. When it reads extreme greed, it marks the worst. Warren Buffett did not become a billionaire by accident. When he said be fearful when others are greedy and greedy when others are fearful, Right now, the market is practically begging you to be fearful. The question is whether you have the conviction to be a contrarian. Let me move to open interest, which is one of the most underappreciated indicators in crypto trading. Total open interest across all crypto futures stands at $98.09 billion, up 2.37%. Bitcoin's open interest alone is $44.63 billion, up 1.82% in the last 24 hours. Now, here is what makes this interesting. Open interest is rising, while the funding rate for Bitcoin is slightly negative at minus 0.0001%. When open interest rises, but funding rates are negative, it means new short positions are being opened. Traders are betting against Bitcoin at these levels. But here is the catch, and this is where it gets really fascinating. The long to short ratio across major exchanges tells a different story. On Binance, the top trader long to short ratio by positions is 1.12, meaning there are still more longs than shorts among the most experienced traders. On OKX, the ratio is 1.78. So while retail is shorting, the smart money is quietly positioning long. This divergence between retail sentiment and institutional positioning is one of the most bullish signals you can find in a fearful market. Speaking of liquidations, in the last 24 hours, $361 million worth of positions were liquidated across the market, which is up a massive 72.88%. Bitcoin alone saw $137.10 million in liquidations, while Ethereum accounted for $69.80 million. These liquidations are predominantly from leveraged traders who got caught on the wrong side of the volatility. And here is the thing about liquidations that most people do not understand. Liquidations are fuel. When leverage positions get wiped out, it creates forced buying or selling that accelerates price moves. The $361 million in liquidations we saw tells us that the market is flushing out weak hands. And once that process is complete, the path of least resistance often reverses. It is like a forest fire. It looks destructive in the moment, but it clears the dead wood and allows new growth to emerge. Now let me take you through the technical analysis across multiple time frames, because different traders need different perspectives. On the daily chart, which is most relevant for short-term traders, Bitcoin is trading within a range of $65,415 to $73,669 over the past 7 days. The key resistance level that everyone should have circled on their charts is $70,500. This level represents the confluence of the prior range high from October 2025, the 50-day moving average, and the psychological $70,000 round number. A confirmed daily close above $70,500 with strong volume would signal that the short-term trend is shifting bullish and would likely trigger a move toward $72,500 and potentially $75,000. On the downside, the critical support sites at $65,000, and a break below that level would open the door to $62,000 or even $58,000 in a worst-case scenario. On the weekly chart, which is the playground for mid-term swing traders, the picture is more nuanced. Bitcoin has been forming a series of lower highs since the $126,080 peak in October 2025, which is technically a downtrend. However, the RSI on the weekly time frame is approaching oversold territory, and the average RSI across all crypto assets currently sits at 50.84, which CoinGlass classifies as neutral. For Ethereum, the setup is actually more compelling from a technical standpoint. ETH is trading at $2,015, down 59.3% from its all-time high of $4,946 set in August 2025, and it is forming what appears to be a falling wedge pattern on the weekly chart. Falling wedges are typically bullish reversal patterns, and a breakout above the upper trend line could target $2,380 as a first objective. Solana at $84.90, XRP at $1.365, and Cardano at $0.2575 are all showing similar corrective structures, with potential reversal setups forming. For the monthly chart, which is where long-term investors should be focusing, the story is actually remarkably constructive. Despite the 45% drawdown, Bitcoin remains in a secular uptrend that has been intact since the 2022 bear market bottom. The total treasury holdings of Bitcoin across institutions and sovereign entities now stands at 1,780,510 Bitcoin, and Bitcoin spot ETFs have accumulated a net total of 700,830 Bitcoin since their launch in January 2024. The Bitcoin exchange balance has decreased by 2,920 Bitcoin recently, bringing the total exchange balance to 2.43 million Bitcoin. When Bitcoin leaves exchanges, it typically means holders are moving coins to cold storage for long-term holding, not for selling. This supply squeeze dynamic, combined with the approaching scarcity narrative as we get closer to the 21 million cap, with 19,999,906 BTC already mined, creates a fundamentally bullish long-term backdrop. Now let me address the elephant in the room, or should I say the elephants, because there are several global events that are directly impacting the crypto market right now. First and foremost is the US-Iran conflict. Operation Epic Fury, which began with strikes on February 28th, has sent oil prices surging over 16% in a single day, with some contracts seeing 30% spikes. Gold has rallied to $5,092 per ounce as investors flee to traditional safe havens. The geopolitical uncertainty is creating a stagflation narrative, which is the worst possible macro environment for risk assets. Stagflation means rising prices combined with slowing economic growth, and it puts the Federal Reserve in an impossible position where they cannot cut rates to stimulate growth without making inflation worse. Second, and this is the single most important event for the week ahead, the US Consumer Price Index data drops on Wednesday, March 11th. This CPI print will determine the direction of every risk asset on the planet for the rest of the week. If CPI comes in hot, meaning inflation is higher than expected, it confirms the stagflation narrative and could send Bitcoin down to the $62,000 level as risk-off sentiment takes over. If CPI comes in soft, meaning inflation is cooling despite the oil shock, it opens the door for the Federal Reserve to consider rate cuts, which would be massively bullish for crypto. The current Fed funds rate sits at 4.25 to 4.50%, and the FOMC meeting on March 18th and 19th will be the next major policy decision. Fed Chair Powell has already flagged tariff-driven inflation and rising oil prices as concerns, and the dot plot is shifting towards zero cuts or possibly just one cut for 2026. Third, the tariff situation continues to weigh on markets. President Trump's tariff policies are creating trade uncertainty that ripples through every asset class. And fourth, there is a development that is flying under the radar but could be one of the most consequential events in crypto history. Kraken has applied for a Federal Reserve master account. If approved, this would give a cryptocurrency exchange direct access to the Federal Reserve's payment system, which would be the biggest structural regulatory shift in crypto since the Bitcoin ETF approvals. It would essentially legitimize crypto exchanges at the highest level of the traditional financial system. Fifth, the non-farm payrolls report came in at negative 92,000, which is a deeply concerning number that reinforces the stagflation narrative. And sixth, Asian markets have been crashing, with South Korea's Kospi and Japan's Nikkei experiencing significant plunges, yet Bitcoin has held relatively steady through this turmoil, which some analysts interpret as a sign of growing maturity and decoupling from traditional risk assets. Now let me give you the trading strategies tailored to each type of trader, because this is where the rubber meets the road. For short-term traders operating on the 1 hour to daily time frames, the strategy right now is surgical precision with reduced position sizes. You should be sizing down 30 to 50% from your normal position size until after Wednesday's CPI data. The key trade setup for Bitcoin is a buy in the $67,500 to $68,500 zone with a hard stop loss at $65,000 and take profit targets at $72,500 and $75,000. However, and this is critical, do not take this trade at full size before CPI. Enter with half your intended position and only scale to full size if Bitcoin confirms a daily close above $70,500 with volume. For Ethereum, the falling wedge setup offers a buy zone between $1,920 and $2,050 with a stop loss at $1,800 and a take profit target at $2,380. The risk to reward on this setup is approximately 3 to 1, which is exactly what professional traders look for. I also want to highlight something specifically for short-term traders watching the derivatives market. The CME Bitcoin open interest stands at $7.10 billion, up 2.36%, which tells us that institutional futures traders are increasing their exposure. When CME open interest rises alongside negative funding rates on retail exchanges, it often precedes a short squeeze. If Bitcoin breaks above $70,500 with conviction, the $361 million in recent liquidations could pale in comparison to what happens next as shorts scramble to cover their positions. For mid-term swing traders operating on the daily to weekly timeframes, the strategy is patient accumulation with defined risk. This is not the time to go all in on any single position. Instead, use a dollar cost averaging approach with a twist. Divide your intended allocation into 4 equal parts. Deploy the first 25% at current levels around $68,000 to $69,000. Deploy the second 25% if Bitcoin pulls back to the $65,000 support level. Deploy the third 25% on a confirmed breakout above $70,500. And keep the final 25% in reserve for either a deeper pullback to $58,000 to $62,000 or a momentum chase above $75,000. This approach ensures you are positioned for multiple scenarios without overcommitting to any single outcome. For altcoin swing trades, wait until Bitcoin reclaims $70,500 before entering any meaningful positions. Below that level, altcoin risk is simply too high relative to the potential reward. For long-term investors operating on the weekly to monthly timeframes, this is genuinely one of the most attractive accumulation zones you will see in this cycle. The fear and greed index at 7, the negative funding rates, the institutional accumulation through ETFs, the declining exchange balances, and the proximity to the 21 million supply cap all point to a market that is offering a significant discount to its long-term value. The strategy for long-term investors is straightforward. Accumulate Bitcoin and Ethereum on a consistent schedule, ignore the short-term noise, and focus on the structural thesis. If you are building a long-term portfolio, a 60-40 split between Bitcoin and Ethereum gives you exposure to both the store of value narrative and the smart contract platform thesis. Consider adding small allocations of 5 to 10% to high-conviction altcoins like Solana and XRP, but only after Bitcoin confirms its trend above $70,500. Let me also share something that the mainstream analysis is not covering. The Bitcoin exchange balance declining to 2.43 million BTC while institutional treasury holdings have reached 1,780,510 Bitcoin represents a fundamental shift in the supply dynamics of this market. We are approaching a point where the available liquid supply of Bitcoin is becoming genuinely scarce. When you combine this with the fact that 19,999,906 out of 21 million Bitcoin have already been mined, leaving fewer than 1,100 Bitcoin left to be created, you begin to understand why long-term holders are not selling despite the 45% drawdown. They understand something that the fear and greed index at 7 does not capture. The supply-demand dynamics of Bitcoin have never been more favorable for patient holders. Before I wrap up, let me give you the altcoin season index reading, which currently sits at 43 on CoinGlass, classified as neutral. This confirms what we discussed earlier about Bitcoin dominance at 58.51%. We are not in altcoin season, and we are not likely to enter one until Bitcoin establishes a clear uptrend above $70,500. The options market is also telling an interesting story, with options open interest surging 160% to $46.32 billion. The options order book shows strong call interest at the $69,000 strike and put interest at the $65,000 strike, creating a defined range that the market is likely to trade within until a catalyst breaks it. So to summarize everything we have covered today, we are in a corrective consolidation phase within a broader bull cycle. The market is showing extreme fear with the index at 7, but the underlying fundamentals, including institutional accumulation, declining exchange balances, and rising volume, suggest that smart money is positioning for the next leg up. The key level to watch is $70,500 on Bitcoin. Wednesday's CPI data is the most important catalyst of the week. Global events including the Iran conflict, FOMC meeting, and tariff uncertainty are creating short-term headwinds but have not broken the long-term thesis. Short-term traders should reduce size and wait for CPI. Mid-term traders should accumulate in tranches. Long-term investors should recognize this as a generational accumulation opportunity. That is it for today's episode, beautiful people. If you found value in this analysis, smash that like button, subscribe to the channel, and hit the notification bell so you never miss an episode. Drop a comment below telling me your trading time frame and what you think about the current market. I read every single comment and I love hearing your perspectives. Remember, in markets like these, the money is made by those who have the patience to wait and the courage to act when the opportunity presents itself. Stay disciplined, manage your risk. And I will see you in the next one. This is Boni, and this is Boni's Life. Peace.